Hello, everyone. I'm John, lead analyst and founder of JP Strategic Investments, and today I'm going to walk you through our bullish thesis for rocket companies. First, I'll go through the fundamentals, then we'll get into the financials, and finally we'll talk about the risk-reward analysis and how we think the stock will perform based on our analysis. So let's dive right in. So the first reason that we're bullish on rocket companies is that the Federal Reserve has essentially guaranteed that interest rates will stay low for the next 2 years or so. Now, the reason this is important is that low interest rates cause an increase in refinances, which are a major part of rocket companies' business. Mortgage rates are likely to stay around the 3% mark, which means anyone with an interest rate above 3.75% or even 3.5% is likely to save a decent amount of money in their monthly payments by refinancing. As you can see from the data here, there are still 18 million homeowners in the US that could shave 0.75% off their interest rate, possibly saving them several $100s a month. This means that there are a lot of people right now who have an incentive to refinance. Many of these people have another big reason to refinance as well, which brings us to our second reason that we're bullish on rocket companies, and that is the number of homeowners with tappable equity available to them. Tappable equity is the amount of money a homeowner could pull out when refinancing while still maintaining 20% equity in the home. This chart shows that tappable equity is at an all-time high of 6.5 trillion. Furthermore, 90% of homeowners with tappable equity have interest rates above the current rate, and 75% of them have interest rates above 3.5%. This, combined with the continued low interest rates, means that there are a lot of homeowners out there that are highly motivated to refinance right now. The third reason that we're bullish on rocket companies is their superior business model. Unlike many of their older competitors, Rocket Company makes the lending process much more efficient and customer-friendly by moving the entire process online. We live in a world today that's becoming more and more centered around the internet and digital connections. With rocket companies on the forefront of this trend within their industry, they are likely to take more and more market share from their competitors. Some might think that this could have a negative impact on customer service and relations because of the lack of in-person service, but this has not been the case. In fact, many customers love their simple user interface and the ability to access almost anything they need right from their well-organized dashboard. Further evidence of their amazing service is their stellar refinance retention rate. Now, the refinance retention rate is the percentage of customers who remain with their current mortgage servicer when they refinance. The average retention rate for mortgage servicers has fallen in the past year or so to 22%, while Rocket Mortgage currently has a retention rate of over 76%. That's more than 3 times the average retention rate. This speaks volumes to their superior platform and customer service. Their digital-first approach also means that their business is highly adaptable and highly scalable. They can shift strategies very quickly and redeploy resources, unlike an in-person business with brick-and-mortar locations. Also, Rocket Mortgage's online model gives them the ability to scale very quickly and efficiently without the need to hire a huge amount of new employees or acquire new local office space as some of their older competitors might need to do. This gives them a huge competitive advantage. The fourth reason that we're bullish on rocket companies is their innovation. We've already talked about their versatile online platform and their user-friendly interface, which they are constantly improving. But another way that they are innovating is through other lending and insurance opportunities, which they are currently in the process of expanding. These opportunities include title insurance, auto loans, personal loans, and real estate agent referrals. So now that we've talked about the fundamentals, let's take a look at the financials. Rocket companies absolutely crushed their most recent earnings report, with revenue up 126% and net income skyrocketing to $3.4 billion. Their balance sheet is also strong as they have $1.7 billion in cash and their liabilities remain low as they resell their mortgages shortly after origination. Overall, they're a solid company financially, and they've shown that they are responsible in the way that they manage their financial risk. Now, there are risks to investing in rocket companies. Obviously, if job losses were to spike again in the near future, we could see instability in the housing market, and it would also reduce the number of homeowners who are eligible to refinance. In our opinion, though, the majority of job losses are probably over, and if they do end up continuing at a larger volume, it will have larger economic effects and it will affect the market as a whole. This means that continued job losses and a potential housing crash, while they will affect rocket companies more, are not risks specific to this stock. they will affect the larger market as well. So with all of this said, where do we think the stock will go? Well, our short-term price target for Rocket Companies is $40 a share. We believe that the stock could reach this level within the next year or so, assuming that the economy continues to recover and that the Fed doesn't go back on their word about interest rates. Long term, we believe that Rocket Companies could reach roughly $80 per share in the next 3 to 5 years. This is because we believe that a highly successful next year or so could allow the company to take a lot more market share from their competitors, as well as put more money and resources towards expanding their other lending opportunities. We believe that this will allow Rocket Company to reach a normalized net income on a quarterly basis of something similar to what they did in the recent quarter. If that's the case, it would only take a PE ratio of about 20 to justify a share price of $80. We think that this is completely realistic and maybe even conservative. Well, that about wraps up our bullish thesis for Rocket Companies. We hope our analysis has been helpful, and please consider liking and subscribing to our YouTube channel for more stock analysis and trade information. Have a great day, everybody.